Hello, future billionaires. Welcome back to another episode of the Invest Like a Billionaire podcast. We had a great episode that I'm really excited for you to listen to. I interviewed Laura Dohanes of My CPA Pros, and we've been talking to a lot of CPAs recently. So it feels like, Ben, I've had enough taxes, but let me tell you, you have not heard enough tax content, because if you're still paying taxes and pay more taxes than you like, there's things you got to do and you got to shift, not only mindset, but strategy and approach that Laura really brings to the table here. So she calls herself a tax strategist. She is a CPA, but just really is very expansive in the topics that we hit on today. And it's kind of funny. I kind of think of her almost like a mindset coach as well as a CPA, which is a very unique combination, but really being aware of what's available to you as an investor and being able to create the best strategy from a tax standpoint that really helps you continue to build wealth over time. And so we had a lot of like philosophical things, but also very tactical, practical examples for people in different situations. So be sure to listen to the whole episode. It's a little bit longer, but a lot of good content. I think you're really going to enjoy some of the things that Laura shares. And if you haven't already, if you're enjoying this podcast, I would just love if you would be willing to give us a rating on Apple or Spotify and leave a little review for us. That just helps us continue to get the word out and potentially get bigger guests on the show to provide you more content that's valuable. So appreciate that. Be sure to subscribe if you're not already subscribed to the podcast. YouTube as well. We're growing our YouTube channel and expect to put out more, YouTube specific content. So with that, enjoy the episode. This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Looking for passive investments done for you? With Aspen Funds, we help accredited investors that are looking for higher yields and diversification from the stock market. As a passive investor, we do all the work for you, making sure your money is working hard for you in alternative investments. In fact, our team invests alongside you in every deal, so our interests are aligned. We focus on macro-driven alternative investments, so your portfolio is best positioned for this economic environment. Get started and download your free economic report today. Welcome back to another episode of the Invest Like a Billionaire podcast. I am your host, Ben Frazier, and we've got a very exciting episode today, talking about everyone's favorite topic that we've been talking a lot about recently. It's taxes, but hey, it's tax season, and Laura Dohanes is the tax strategist, founder of My CPA Pro, and she's going to blow our minds today. So I'm very excited to have her on. We've talked a little bit before a few times, and I've really just love the knowledge that she brings. And so, Laura, thanks for coming on the show. Give us a little background on you and kind of how you work with folks, and what's a tax strategist do, right?
Yeah. Thank you for having me, and it's exciting. Listen, one of my favorite things to say to people is like, when you think about an enemy or you think about a friend, taxes are many people's enemy. They look at it as this nemesis. You can never win against this giant, right? And I'm here to tell you that you can literally befriend this thing, right? If you make peace with yourself, understanding and making peace that this is an ally, and you befriend the ally, right? This is becoming part of your strategy, part of what you do, because you can never escape it, So I'm really excited. My most exciting moment is when you understand that no matter how the politics go, the economy goes, you always have an ally. There's always something for you to take out of it. And this is my role as a tax strategist. The opportunities are always there. We never lack opportunities and options. And people I meet with my clients, with people all the time, and they say, there's nothing else left. We're done. I said, you just lost the game. So once you decide to win the game, no matter what happens, no matter how the economy goes, this is where tax strategy can give you so much more in everything that you do, because everything that, how I like to explain people is, what does tax strategy really do? It's really the end of the rope. All the cash movement, everything that you do, like the income that you draw, the expenses that you have, deductions, you're trying to make investments, they all end up, the end of the rope is the tax. When you exit, when you die, when you sell the thing, everything that you do ends in tax. So if you think about tax strategy from the point of what do I want to achieve, where do I want to go, taxes become this exciting moment. This is the end, right? So this is really what we do. We're looking at how is the end looking for you, and how can you make that exciting moment when you exit to actually look forward for your exit, whatever the exit is. And if you don't think about it, guess what? Everybody's going to exit. Everybody's going to exit one day with death, right? So either or, exit is inevitable. And it's the most exciting moment, right? So that's, I mean, I get too excited about it, but that's
I'm glad you're excited about it, because I think, yeah, I think a lot of people are glad that you're excited about it and that we don't have to be, but you can, be contagious and help us navigate it, right? Because I mean, it's, the idiom is there's nothing, certain except for death and taxes. And it's not something that at a certain point, right? If you just stick your head in sand mode, go ostrich mode on this and, don't think about it, you're still going to have to deal with it at some point. And if you don't, then your kids will, right? If, through state taxes. And so just let's take a step back. I have so many questions and love to get into this. But one of the things you said a minute ago before we hit the record button here was, a lot of the things that you help people navigate is the strategies that these, ultra high net worth families are using, say the 20, 30 plus $1 million, net worths. Taxes is something they're thinking a lot about, right? Because you don't get to that level of net worth without having some sophistication around, how are you going to handle the taxes, unless you have a huge liquidity event, but then you're going to have to deal with taxes, right? So
yeah,
you kind of then help people, maybe at the lower net worth range of, $2 to $5, $10 million ranges, use these strategies that can help propel you to that next level of income and growth. And talk a little bit about what are the strategies, what are the things, maybe even mindsets that people are using and frameworks that they use to, get to those levels of net worth.
Yeah, and it's really exciting what you just said, because many people, I think the downfall is where we think, well, we're not there yet. This is not for me. This doesn't work for me. So we, with our mindset, can literally block something that could be tremendously beneficial to our wealth building, and not just wealth building, but tax strategy, because we already cut it off that this doesn't work for me. I'm not there yet. And listen, I have people who can bring 10 million in a year and say, I'm not there yet. And I have a person that brings $1 million a year and can have much more, mindset like shift. Say, you know what, I'll do whatever it takes, right? So you can only go as far as you let yourself go with the tax strategy. And now some of them have other risks, and it comes with risk aversion. Really, I think this is the moment, because the first step in tax strategy is understanding how much money you make and how much is your lifestyle cost you. This is, I think, the missing element when people don't understand. So we always begin with the basics, because the number one step that you want to know is, okay, how much do I live? Most people, it doesn't matter how much money they make. It doesn't matter what kind of investments they have. Most of the people live between anywhere but 150 to 300,000 tops a year. And $300,000 a year, most people in the United States right now as a family, and I have 3 kids in private school, you can live very well with that money. It doesn't matter where you live in the US, right? So you can do it, you can have a decent living, right? Now, once you have established what's your lifestyle costing you every year, okay, you have to decide the excess, what you're going to do. And I'm not going to use the Dave Ramsey's approach, which I love the guy. It works very well for many families to begin the process. That is the baby stage of investing. It gets them on a track. But the same concept he applies, like you have to allocate all the money. Now, all the excess that you make, you have to allocate it. You have to learn to spend. And I think this is where people kind of miss the boat on. When I go through this process, when I start investing, they don't have the end goal in mind. So one, you know how much my lifestyle costs. Okay, if it's $200,000, okay, $200,000 for my lifestyle. If I produce $300,000 this year, I have $100,000 to invest. And they invest mindlessly based on what they see. You go on LinkedIn, you go on all these podcasts, you go to this conferences and say, real estate investing, and you go crazy. Multifamily investing, opportunity zone, all the shiny objects that show up, right? They're all amazing, but not all of them apply to you. So I think they don't think about the investments and how is that affecting them. And now they come to us and say, well, I invested in this real estate. They told me it's the best thing ever. This is gold. And I have no advantage. And I still pay the same tax bill. I can't take advantage of this. I can't do all of this. So if you have the high net worth individuals, before they invest, they think about, how is this going to affect me? How is my exit going to look like? How is that going to look like? And before they even put the money into any investment, they decide, what entity should I use? What is more beneficial to put it? This is where people are like, oh yeah, I have the cash. I'll just go send the cash.
What I've seen so much, right, when we're working with investors, and we're not at your level of strategists, and we actually can advise, right? We're not advisors. But what I see so much is this common thread of people get excited about investing in real estate or investing in alternatives, right? And now the whole world's opened up because there's other options than just mutual funds or stocks and bonds. And it's exciting, but then what happens is they just start investing in random things like you're saying, right? Where they source it on LinkedIn, or my Uncle Jerry over here is doing a flip, and my doctor friend over here is investing in this ATM fund. And you start to just create what I call the sock drawer of investments, right? You don't remember what you invested in. You just start randomly, haphazardly investing in things. And then you take a step back a couple of years down the road and you're like, there's no strategy behind it. And I don't really know what I have, number one. And number two, I don't know if I'm at any better spot than I was when I started, And so I think it's so important going into this, from lots of different angles of education on, understanding investments in general, but then the tax side of it, understanding the impact of the portfolio strategy is so important going in, right? And this is one, defining what is your ultimate goal, what is your end goal, can be a really helpful framework that's just going to naturally exclude a lot of things that aren't even bad options. They're just not good options for you, which is what you're saying, which I really love. Can you give us some examples of maybe, broad categories of different kind of archetypes for people that are maybe in different situations to where, certain types of things might not be a good fit for them given where they're at on the path?
Yeah, and I love what you just said. And I was thinking about a couple of examples. So let's take a typical investor right now, or high wage earners, right? You have, you're in the tech industry, you get a lot of stock options. Let's say this is a very typical example. These people invest, right? So let's say you are a W-2 wage earner. Let's say you make about $400,000 or $500,000 into W-2 wages. You get stock options. You get a lot of capital gains every year because of that. So these people typically live very modest lives, like very frugal. They invest a lot of money. Most of the people that we see are high wage earners. With that, one of the basic elements that happens is you have to understand you have ordinary income, wage income. If you're going to invest in real estate, it's not going to help you. Nothing's going to help you. And listen, all the capital gains that you have, you're just paying tax on them. You're not drawing losses. And when you exit, you pay capital gains on it again. So one of the when you implement tax strategy, one of the basic things that I always ask people, you have to understand, if you make an investment, if you put the money anywhere, anything you do, you have to understand what's the goal. The goal with tax strategy for the people that we work with is, I'm going to cut my tax so I can invest more. It's not going to increase my lives. It's not going to change anything on my lifestyle level. It's just liberating the cash. It just frees up more cash. It gives me access to cash to put it back in the machine. Whatever it is it going to be private investing? Is it going to be mutual? It doesn't matter what the investment vehicle really is, right? So come back to our guy. Let's say he's a tech person making $400,000 in wages, and he has like another $150,000 in capital gains. Now, real estate investment is going to do nothing for them, right? It's going to build cash, but like he reduces his gains. Depending on if this guy lives in California, he reduces his gains by 40%. So if you're getting cash on cash, like you look at what they promise on cash, cut 40% on that.
Mm-hmm.
because you just deplete, you just reduce your gain. Now, give the same person, right? Like we have multiple, like, guys that have multiple investments. Now, let's say we open up a holding company which we're going to invest in. For these people, we cannot do pass-through. It's very common that we can create a C Corp for these people to invest. Now, many people that are not there yet in their minds, it's like, C Corp, this is the evil of the greatest evil on planet Earth. We cannot do C Corp, you should see all the CPAs, double taxation, horrible, throw an apple on her face. No, listen, all entities are great for different things. Once you understand that everything is there for you to use, if you understand how to use them, okay? So let's say we have a C Corp. I mean, I'm giving you like advanced methodology, and you can have multiple investments in a C Corp, right? Now you just slash all of that, and you can keep investing in different things, and you take advantage of it outside of your personal return, right? One of my key elements that I use is I've done more than 3,000 audit defense cases face-to-face with the IRS, okay? Me personally, okay? Here's one
They
of
probably love you, right?
I mean, listen, they wanted me on their side, and there's a reason why I'm this side of the table. Let's just say
Right.
that. So one of the most basic things that you could do is free up your investments from your personal tax return. You won't see, a high net worth individual, parading all the investments, all the 20 state investments that he has on his personal tax return. And yet we see people with 40 different, syndicated deals on his or her name, and it all shows up on the personal return. You just expose and parade all of it in front of the IRS and give them excuses to come look at what you're doing. Right? So you have to use entities. So especially if you have, high income, like an employee, use entities. They're there for you to use to invest in specific, entity types. So you don't go in as an individual to invest in all this, additional investments, especially real estate, any alternative investments that you have, right? That's a clear example. Now, if you run a business, right, which we have a lot of business owners, everything changes. And the same thing, we don't want to touch necessarily the operating business that you have that produces the cash. We want to use entities, right? So entities is your number one friend, and you have to structure that really allows you to take advantage of the current law that exists, right? And that changes every year. And I think, listen, the same way in your investments, tell me if I'm wrong, people say invest in kind of spread your eggs in different basket, right? You invest in this, you invest in mutual funds, you have some, you might have some, EFT funds. You can spread out real estate. You can have multiple eggs in different basket. The same way, I find it very beneficial to have various types of entities because each one of them has different advantages for different types of investments, for different types of income. Okay, and that's where it gets really, really exciting, where you can generate something like you always paint a picture with all these entities and how you can invest in different entities.
Yeah, it's so interesting. So without getting too technical, as I know a lot of this, matters on your personal situation and what types of income you're generating. When I think about investing through entities, most of my understanding of that from, the limited amount that I know is mostly from an asset protection standpoint. But you're saying it's also from a tax standpoint, there are advantages, to use different entities for different types of investments. And going back to the C Corp, because I think, you kind of glazed over that, but you probably blew a lot of people's, brain sockets here by saying that, because I've heard the same thing, right? Going to business school, the only thing I remember about C Corps is double taxation. And, most publicly traded companies are C Corps, right? But you just assume that that's what they have to do as part of being a publicly traded company. But there are situations that you're saying where it actually might make sense to have a C Corp. And in this scenario with this high wage income earner in California, we have extremely high level of, income tax, federal and state. It might actually make sense because the tax percentages on a C Corp are less at the corporate level. And then you're only paying the double taxation when you make distributions, right? So, the numbers, maybe correct me if I'm wrong here, but the corporate tax levels are much lower than 40%, right, on the C Corp itself. And so if you continue to kind of snowball that and you're saving potentially 50% in taxes, that's a pretty significant number. And then as you make distributions, there's probably things and strategies you can employ with your distribution strategy to limit, further. So get a little bit tactical, but I do think this is really helpful because I know there's a lot of people in that boat of really high income earners that liked the idea of real estate investing and paying less taxes, but all of a sudden they make a few investments and realize, oh crap, I'm actually not reducing my W-2 active income, right? So maybe spend just a few minutes on C Corps, because I do think that's a very counterintuitive idea here.
Yeah, well, listen, I'm battling, here, many large CPA firms and CPAs that have been in the industry, and they still I think they missed the boat on the advantage that they could do. And listen, the reason why I believe C Corps are great, because my end goal is my C Corp is going to end up in a trust. That's what people miss. C Corps are not used for you to live off of it. I'm not using it's a holding company. I'm not going to draw dividends. I'm not going to draw a salary. It's my vehicle. I keep it there almost like a bucket, which will hold my investments, right? And where people miss, a lot of the, the fine nuances of investment is where they have an investment advisor, they have an estate attorney, and they have a CPA, and there's no connection.
Mm-mm.
Each one of them will give you something else. The investment advisor can bring you the best investment in the world. It can have the highest returns, right? It gets really... So then you can have the estate attorney who's like, he protects you the best way ever, right? It's so cool, the protection it gives you. And they want to give you the best. And the CPA that gives you the highest tax ever, right? So the missing element is a connector that would bring all of this together. Say, where I invest, it really has legal protection and it gives me the highest tax. This is the element. And this is what we're kind of creating this tango, this dance around it. So our clients, we meet with the attorney, we meet with the investment advisor, we analyze the deal. How does it fall in? We tell them in which entity you have the highest tax advantage to invest, right? So coming that to kind of having that as a foundational piece, as a basis, right? You come back to say, where and how would the C Corp help? You think about the C Corps, and I give this analogy to my clients all the time. Think about it. When you set up the C Corp for you to invest, it's almost like a 401k. I'm not touching that 401k. It's not for you to live off of it. It's no dividends. Don't ask for the money back. You put it in. It's gone. Do you know what I mean? Because listen, people are people. They put an investment, and they're like, a couple of weeks in, I'm like, oh, am I getting distributions yet? I'm like,
totally, yeah.
I go back and I say, so let's go back to what was the goal for this investment?
Mm-hmm.
People go in, and this is one of the most common mistakes they make, especially the people who are not running businesses, because when you run a business, you know goals, you track goals, you have metrics, you've got to track the metrics, otherwise you're out. So people who are employees are still not, it takes them a while to kind of wire their mindset to tracking the goal. The goal is what? Was it cash flow? Was it appreciation? What was your number one goal for going into that investment? Because if you go into a real estate investment and you want cash flow, which you don't need cash flow because you have high wages, it's wrong. You missed about. You didn't have the right goal. It's never gonna. It's not gonna work. It's not gonna give you. You're not gonna be happy, and you're gonna go to another investment and you say, well, this is not doing well. I'm gonna go use a different, avenue to invest. And you keep switching and going and searching for that golden egg, and you're not finding it because you don't have a clear goal, or the goal that you have does not make sense. You think you wanted that. You think you want cash flow, but you really don't want cash flow. You want appreciation because you already have the cash flow. You have met your basic needs. You have met your lifestyle cost. So C Corp is not to give you anything. You're building it to an end point where that C Corp is going to land in a trust. And that's where advanced strategies come in play, which is, it's just, listen, when you look at the whole thing, it's so beautiful. Like there's such a natural transition through things. You just have to be open to understand, open to explore the options that are available to you.
Totally. Let me roll another scenario by you, kind of a different side of the spectrum here, but it's also something like I know I've talked with people recently listening to this podcast that they're entrepreneurs or business owners. They've been reinvesting back into the business for a long, long, long time, thinking, hey, I'm kind of ready to sell, be done with the day to day, but I'm going to have a massive liquidity event or a lot more than I'm used to. And the first thing I think of is massive tax bill, right?
Yeah.
Can you give just some high level strategies? Again, this is highly personalized, I know, but what is someone in that scenario, what can they be thinking about, right? Because you want to be thinking about this many years in advance, and there's lots of ways you can structure, buyouts, other things that can be more tax friendly. But what are things that this type of a person should be thinking about that's obviously very different than the high wage earner that's, just stocking investment capital away and, maybe put it in an investment vehicle. But in the other kind of side of this, the entrepreneur that's looking to sell the next couple of years, what kind of things do they need to be thinking about?
Yeah. And, there's so many great things. And I'll give you an example. Everybody knows Facebook, and, the founder of Facebook is really famous for many things, some good, some bad. Let's just say that. And he and his wife were bragging on the internet how he donated 99% of his stock to this charitable company. Right? And all these people came and attacked him. And I'm like, no, that's not true. It is true. Or that's not even charitable. That is charitable. And, listen, I don't see him as the most giving guy necessarily. Right? I mean, I might not be the nicest person when I say that, but listen, like they're giving as a strategy. Okay. So you have to understand, you have to deploy things and get out of the classic definition for charitable. When I talk to charitable, people are like, they dismiss me. When I say charitable, their mind has literally completely shut down on the concept of charitable. They said, she wants me to give it away. I go to tax strategy, I pay a boatload of money, and she's telling me to give it away. It sounds stupid when you think about it this way. But this is where people miss the boat. That is one of the most favorable things. United States, as the law exists right now, the tax law, has so much opportunity. We have several charitable strategies. It's one of the most amazing ways you can save money. And it's not because you give for the sake of giving. You give as a strategy. Okay, right? One of the best ways people approach this is giving. Now, can you give stock? Can you give, stock is a great thing to give. Right? It's not just that. You can, when you exit, when you have a large exit, and people have exit $50, $100 million for, let's say they build this, manufacturing company or distribution company, or whatever they have, and they have, a suite of government contracts that are valued really high and they want to get out, right? What happens is, what gives you the highest advantage is when you layer different tax strategies for a compound effect. When you use entities, you use trust, you use charitable, and you create this diagram of a beautiful exit. He ended up paying for his Facebook donation 1% tax. Based because he was able to get out of his mindset. It's like, I'll do what it takes.
Right.
So it's a tango. It's literally.
Yeah. You're saying too, giving as a strategy, not even for charitable causes, but it's kind of a dual purpose too, right? If you have any desire to leave a legacy or to actually make an impact with some of your wealth, you're well above your means. You kind of have a dual purpose, right? Where you can actually save on taxes and you can make some impact too. So I think it's something that should not be overlooked and can be pretty significant, right? Because you can use a portion of the donations against other income, right? And so I can get too technical, and I can, I'll probably say something wrong, but as a strategy, it's a very important kind of thing to layer in there. You're saying,
just another comment to what you just said. So I typically like to separate things. So if you have a charitable cause, if you have something dear to your heart, and I know many people who have survived different types of cancer and they've created nutrition, they've created supplements, they've created something, they have a child with disabilities, or they have a very specific cause, or literacy, or sports, or music, whatever the cause might be. Or some of them are investing overseas, right? They have something dear to their heart, but it's in a different state. I have, engineers that are Indian, like from India, and they say, I want to help farming in India, right? So we separate the strategy, the charitable strategies, from your charitable purposes, because
Okay.
I like to be protected. So that's one of the things that, if you want a nonprofit, if you want a foundation, and most of the wealthy people have a foundation, most of them. Like I have almost everybody that goes up their specific level, they have a desire, because when all is said and done, you want something that fulfills you, right? So for me, one of the causes that is dear to my heart is, families where one of the parents or the spouses is going terminal illness, and it's really brutal, and they're not financially prepared. That's one cause that's really dear to my heart. That's where I'm focusing, right? How do you get them financially prepared, that especially if they have kids, right? It's really brutal for a family. They don't know what to do. That's one cause. That's separate than the charitable strategies, and I like to keep them separate because of the audit defense mechanism. I don't want the IRS to say that I'm funding my own cause with these charitable strategies. So I always separate these two, right? So charitable strategies is a strategy. In your foundation nonprofit, we use it as a true nonprofit, because listen, it's not just a game. It's life. It's your life that you're playing with, and you don't want everything to be a tax play at the end of the day. You want it to have meaning and impact. And that's how you provide meaning and impact. Strategy is one. I mean, I'm not saying you shouldn't there's a little overlap, but if you have your own foundation nonprofit, I like to keep it separate. Like 99% of the time, we'll have it separated.
Right.
Yeah.
But if you have your own foundation or nonprofit, you theoretically can have some level of control or decision-making, whether it's you have a board or other things alongside of it. But now you can actually be more directive with what you're doing, but still get the benefit on the personal or trust side of things from a tax standpoint.
Yeah, for sure. The benefits on the strategies are, 4 or 5 times bigger than what you do with your own nonprofit. Just to give you a value put on it.
One of the last kind of topics I want to hit on, and we don't have to get too much into the weeds here because we could probably nerd out for a long time, but something that I'm kind of becoming more aware of over time, right, as I've made a lot of investments and, earning different types of income, I'm realizing there's not always a simple onesie twosie, you just match this income with this tax loss, right? It's more complicated than that. And, the different types of income you're generating, like in the one example with the tech employee, it's all W-2, like that's pretty, vanilla, let's say. And it's pretty clear you can't take, passive losses from investments against that income. But as you get more kind of nuanced, maybe kind of start as more of a framework, but then maybe some examples, if you can, on, ways to be thinking about it. Because if I know the types of income that I'm generating, and I know what types of losses I need to generate from an investment standpoint or a tax standpoint, it kind of, again, going back to what's your goal, shifts the focus of the strategy of maybe things you should be focusing on, right? And so again, another kind of layer of it, but this is an area I talked a little about before in our kind of initial interview, and just wanted to dive into that just a little bit, because I think it's something that's so relevant and important.
Yeah. And thank you for bringing this up. I think it's a great topic that is very misunderstood, even by CPAs, because they say it is what it is. This income, it is what it is. You get the deduction, you don't get the deduction. But once you have to look at what the millionaires and the billionaires are doing. Okay,
You're speaking my language here with the name of our podcast.
So listen, like, when we look at geographical, like, people have, decided how water streams should go because they wanted water to flow in specific areas. So the same thing, that's the definition of income shifting. you have to understand, is it valuable for me to have all this income here? Is there any way I can shift any of the income in other places where I can take advantage of it? With the W-2, it's not always possible, okay? So that's why I said, depending on what you do, it's really, you have to understand what do you have to play with. So let's say you are stuck, right? You are stuck. Let's say you're 500,000 in, and we have employees that make $500,000, $600,000, $700,000. It can be investment advisors at Wells Fargo. They make $700,000, $750,000 a year, okay? Right? Typical example. And they're doing investments and they cannot help themselves. Didn't want to have the sarcasm there, but so let's say we have 500,000 in W-2 income. Cool thing. Got it in. There's no way out. W-2 straight through, right? There's things that you can still do. You have to look at the tax law allows you to have some deductions against it. So, that's where a lot of people love oil and gas. And they live for oil and gas, because oil and gas, if you have active participation in it, you can have that deduction, right? For the intangible drilling cost, right? Year one. What do you do year two? You have to put another 100,000, 200,000 in to get the same deduction. So there's multiple types of investments that you can layer. Entertainment or any type of active investment, investing into, private equity or, different funds that would give you a deduction year one. The number one element for the people, and this is many people will not like what I say right now. 500,000 up to about 8 to a million is the absolute hardest kind of gap that you can be the hardest place you can offset income, because they just don't have enough. And they're right in the middle where it is the absolute hardest to reduce. I've run calculations. I said, what if we do charitable this? If I do this, the amount of tax reduction is so minimal that you have to put so much money in to get the reduction. It is the absolute hardest to minimize tax on. I know many people will not like what I say. And that's why you have to either go big or go home. No, not saying go home.
Go big or make less money.
But you understand, I ran scenarios over and over and over again to find out. And it's 500,000 is probably the hardest place to be at right now, right? Now, some states, for example, if you're in a high tax state, makes it a bit easier, right? Because now anything that we do has a little bit more tax impact. If you're in Texas, don't make the money, right? You have to find something else. So you have to strategize. What can I do, right? You're after you go over that 250 range, 300,000, you have to spend money to save money. Okay. Now, when I look at spend money, let's say I put $100,000 in for an oil and gas deal. Okay. Let's say I get 85% in IDC cost, like deduction, like intangible drilling cost. I put 100,000 in to have a deduction. That means it reduces my $500,000 income by 85,000. The impact might not be as big. If I put 100,000 in, I'm not going to get $100,000 off my tax bill. It's probably going to be anywhere from 15 to 25,000 tops. So you have to put so much more because of that, because this is the hardest place. You don't have the tax rate is not big enough. Even though it is big, it's not big enough for you to make. So the more you make now, if you make 700,000 and you put 100,000 in, you actually can have a higher tax advantage. You might save more, percentage wise, than if you make 500,000. Why? Because of marginal tax rate. Right? So you have to understand that the taxes are in brackets, right? So if you make 500,000 and if you're married, at the top bracket, you're only having a little bit of income at that top bracket. So that means the advantage is not as big. The more you go over the 500,000 range, the amount of money or income that sits in the highest top bracket is higher. So it makes more sense for you to put more. So I can put 200,000 in. I can put 400,000 in an oil and gas deal, perhaps, to get the advantage that I want, and I can reduce my tax to almost zero. Right?
Yeah, makes total sense. Yeah.
So it's really all about the how do I organize? Where am I with the income? Is there anything I can do to shift, right? And it's not just that. There's entertainment investment. Entertainment, or any other strategy that gives you, some losses. And, in the real estate world, the short-term rentals took a really big hit, right? Like everybody was like, this is this thing, it's an STR strategy, it's a new strategy. It's not necessarily a new strategy. It's like if you're active in it, the problem is it's not going to give you losses. I mean, you can buy a large property and you can do cost segregation, you can do all the beautiful things that you could do in year one, but then a well-run, SDR will actually give you profits. So you're still not
Right.
you're still not where you want it to be. But there are strategies, and most likely for the people in W2H, it's going to be some private equity investing. Some of the other things, there's strategies that we do in the entertainment industry that would allow us. It's a Section 181. I know people don't want to hear the code today, but it's a Section 181 that allows you to do some additional entertainment investment for these people to have a really, really good, reduction of their taxable income.
Yeah.
Right. And that's probably the top one that I would use for a W-2 employee. But again, it comes with people don't like entertainment so much. People don't want to invest in entertainment because they don't agree with it. Right. So it's all coming down to what's your mindset? What are you willing to do to reduce that bill?
Yeah. How do you balance, kind of last question here, and this is something I've said a lot and I think is important, but yeah, you got to measure the impacts. The idiom is don't let the tax tail wag the dog, right? You shouldn't just do an investment only because of the tax savings. And, in oil and gas, a great example, you get these great losses, but if you invest in a really risky project and you end up with a permanent loss, right, a capital loss, you're not really that much further ahead potentially. But how do you kind of balance that? Because if you are getting that significant of year one losses, the riskiness is kind of reduced down, right? Because you're getting so much in tax savings, potentially. It depends on your income level, right? But how do you kind of balance that approach of not letting the tax drive the investment strategy, but also letting that be a really key component of it?
Yeah, and it's a key distinction, and it's such a great point. Thank you for bringing this up, Ben. It's there are strategies that are just pure tax strategies, and there are strategies for wealth building.
Yeah.
Okay. So it's always a dance. So we had people, put $100,000 in or put money in, and the tax advantage was $150,000. That's a tax strategy. Okay. That's not, you don't ask for your money back. Don't ask for a multiple. It's a done deal. It's a one-time deal. Sometimes we have strategies that we present our clients that are just like that. Take many different shapes and forms.
Okay.
So, I always say this is a one-time, it's a tax strategy. It's not a wealth building strategy, but you've got to do both, right? So you have to just make a distinction. Like, remember we talked in the beginning, what's the goal? Is my goal to, if I do an entertainment, my goal is to increase my wealth or reduce my tax bill. So every single time you reduce the tax bill, the main reason you reduce the bill so you can put the money into wealth building investments.
Okay.
So it's always this tango between the two of them. And I think the biggest mistake people do is like, oh, I'm just building wealth. Real estate has stuck to people, or all alternative investment really. People are ATM, car washes. There's so many different, trends that are coming up right now that are really, really hot, assets to invest in. And people are going by the masses like this is the greatest thing. And I'm like, they have to understand what's the goal. What are you doing for wealth building, right? And then once you have the wealth building strategy, and that's a and we talk about infinite banking, velocity, but there's just so many like I said, we can talk for hours just about those concepts alone, right? Which I love. Each one of them are valid. You have to create that dance, the tango between what you're doing for wealth building with the tax strategy combined. Because as you create more wealth, you don't want your personal tax return to show that you're richer. I mean, why should they know? Why would they have to know?
Yeah.
What you're doing.
Laura, this has been, this is so fun. I feel like we need to have a part 2 here at some point, but for our listeners' sake, we should probably wrap it up here. Who's kind of like your ideal people that you can work with, right? I mean, it sounds like there's kind of a wide range, but, give just an idea of who are the best people or most qualified to kind of benefit from some of the things you guys do at My CPA Pro.
Yeah. So in a nutshell, our ideal people are the people who make at least $100,000 more than their lifestyle cost. That means they have money to invest. They generate excess cash. That means W-2. If you're a business and your business generates more cash than your lifestyle, that's the tax planning area for us. That's the range. The more you have, the more you can plan.
Love it. And then what's the best way for people to get a hold of you?
Yeah, definitely. So I put this, if it's okay to share this, I put this resource together, for you, so you can get in contact with me and my team. And if you can go to cashprofitpower.com, we put like the 5 most common strategies that all the ultra rich, the millionaires and the billionaires have in common. Every single one that I have seen, that I have analyzed, that I have looked, are using these strategies 100%. It is mind-blowing to see how simple it is to get in the mindset of a millionaire and billionaire. So, if you go at cashprofitpower.com, you can put your email address and you can get in contact with us. You can also find me on LinkedIn. LinkedIn is the place I hang out. Laura Dohanes on LinkedIn. Maybe we can put a link, but that's where you can find me. And you have a booking link. You have all the goodies on LinkedIn as well.
Hey, love it. Well, thank you so much. This has been really, really fun. I'm sure our listeners will get a lot out of it. So thank you so much for coming on and sharing your wisdom.
Yes, thank you so much, Ben.